Welcome to Griffonomics. Right now, the most vital player in the entire artificial intelligence revolution, it isn't a Silicon Valley coder, and it's not some, microchip engineer either.
No, not at all.
It's actually a shuttered 15-year-old nuclear reactor in Pennsylvania. So today we're doing a deep dive into a comparative analysis of Vistra Corp and Constellation Energy, which trade under the tickers VST and CE.
Right.
And if you've been watching the infrastructure space, you know that these two companies have, they've effectively become the landlords of the AI boom.
They absolutely have. I mean, we are looking at a fundamental rewiring of how compute power is sourced, how it's funded, and how it's physically generated.
Yeah.
We've moved way past the theoretical phase of this AI supercycle. We're in the physical deployment phase now.
Which means securing actual megawatts.
Exactly. Securing the localized megawatt hours that are required to actually run these massive server clusters.
Right. And what's so compelling for you, the listener, as we dig into this massive stack of sources today, we've got Q1 2026 earnings transcripts, Form 10Q filings, corporate presentations, and some really detailed institutional analysis reports.
It's a huge stack of data.
It really is.
Yep.
Okay, let's unpack this, because Vistra and Constellation are tackling this exact same macro environment, but with two radically different philosophies.
Yeah, polar opposites, really.
Exactly. The analogy I like to use is think of Constellation as a massive, unstoppable bullet train, right? It's a pure, clean, premium asset running on a very highly specific track.
I like that.
And Vistra, on the other hand, is an all-terrain vehicle. It's this highly agile, generalist machine. They're combining nuclear with a really aggressive natural gas fleet.
What's fascinating here is that this isn't just about who generates more power. It's about fundamentally different architectural philosophies. Constellation, or CEG, they're banking on the unmatched premium of 100% zero-emission nuclear power.
Right, the purest play.
Exactly. While Vistra is playing the, what you could call the grid arbitrage game, they're spread across the ERCOT and PJM grids using flexible, dispatchable assets to exploit spot pricing anomalies.
So to really understand those philosophies, we need to look at the raw mechanical variables from their recent Q1 2026 scorecards. Let's start with Constellation.
Sure.
Because if we look at their financial architecture recently, it just underwent a massive, frankly, kind of messy transformation.
Yeah, messy is a good word for it.
They didn't just, quietly sign a few nuclear deals. They went out and bought Calpine Corporation.
Right.
And that acquisition completely distorted their top-line math. So break down the mechanics of Constellation's quarter for us, because those headline numbers look almost absurd.
The headline numbers are totally staggering. I mean, you really have to understand the accounting math to see what's actually happening under the hood.
Right.
So, for the 3 months ending March 31st, 2026, Constellation reported consolidated GAAP operating revenues of a massive $11.122 billion.
Wait, $11 billion?
Yeah, over $11 billion. That's an absolute top-line step change. It's a 63.8% surge compared to the exact same quarter last year.
But a normal utility does not just organically grow its revenue by nearly 64% in 12 months, unless they, doubled their rate base, which they definitely didn't.
No, they didn't.
So this is entirely the Calpine integration driving that.
Entirely. So on January 7th, 2026, Constellation closed that Calpine deal. And instantly, they absorbed 23 gigawatts of competitive natural gas, oil, geothermal, and solar generation.
That's a massive amount of capacity to just swallow whole.
It is. But here's where the diagnostic waters get muddy for anyone trying to analyze this. When you execute an acquisition of that scale, your GAAP numbers, the generally accepted accounting principles, they get heavily distorted.
Right, because of integration costs and all that.
Exactly. One-time integration costs, you assume a ton of debt, and you have the amortization of intangible assets. So on a GAAP basis, they posted this skyrocketing net income of $1.590 billion.
Which is what, like $4.49 per share?
Yeah, $4.49 EPS.
Which obviously looks incredible on a press release.
Oh, Wall Street loves it on the surface.
Yeah.
But as an analyst, if you're trying to figure out how much cash the actual underlying power plants are generating, you have to isolate the normalized baseline execution. You have to strip out all that one-time acquisition noise.
Okay, so what's the real number once you do that?
When you look at their adjusted operating earnings, it came in at $972 million, or $2.74 per share.
Wow, okay. So from $4.49 down to $2.74. That's a huge gap versus non-GAAP distortion.
Massive.
But I've got to push back on this a little bit. If Constellation is supposed to be this, premium, carbon-free purist, why on earth did they just drop billions to buy Calpine? I mean, Calpine operates a massive fleet of natural gas and oil plants. Doesn't that completely dilute their whole green thesis?
It sounds like it does, right?
Yeah.
But it's really a strategic concession to physical reality.
Okay, how so?
Well, yes, Constellation absolutely wants to sell pure nuclear power to Microsoft and Google.
Yeah.
But they still have massive legacy retail and wholesale obligations on the broader grid. And the thing about nuclear power is that it's baseload.
It runs flat, 204/7.
Exactly. It cannot ramp up and down quickly when the sun sets or, when a heat wave spikes demand right at 5:00 p.m.
Right, it just hums along at one speed.
Yeah. So by acquiring Calpine's 23 gigawatts of dispatchable thermal assets, Constellation essentially acquires the essential peaking capacity they need to balance their overall portfolio.
Oh, I see. So it allows them to fulfill their regular grid obligations without having to take their precious nuclear megawatts away from the hyperscaler contracts.
Precisely. And to answer the obvious question of how quickly is this massive new asset actually paying off?
Right.
The sources show Calpine pulled in a massive $2 per share full-year corporate EPS accretion. From the acquisition date to March 31st, operating revenues attributable just to Calpine were over $3.1 billion.
Wow. Okay, so it's paying off, but it wasn't a totally perfect quarter for them, was it?
No, they had some real headwinds. They faced some compression in state zero-emission credit pricing, or ZECs.
Right.
They also had a higher volume of planned nuclear refueling outage days. I think it was 99 days versus 88 days last year. And they faced higher costs to serve load during Winter Storm Fern.
Okay, so if you're modeling CEs, you have to take all of that into account, right? But you also have to factor in that they affirmed their full year 2026 guidance of $11 to $12 per share.
Yeah, and they're projecting base earnings compounding at over 20% through 2029. It's a massive growth trajectory.
So that's Constellation doubling its baseline via acquisition. Let's pivot to Vistra. Because Vistra pulled off a record first quarter without a massive new merger closing in Q1.
They did.
Let's lay out the numbers. Vistra delivered $1.494 billion in adjusted EBITDA. That's a calendar first quarter record for them. It's up 20% year over year and nearly 85% from Q1 2024.
The turnaround is incredible.
Yeah, CHAP net income was $980 million, which is this massive structural turnaround from a $317 million loss the prior year. And here's where it gets really interesting. They did all of this while the weather in Texas was actively working against them.
Yes. This is where understanding the mechanics of the ERCOT grid is just crucial.
Right, ERCOT being the deregulated Texas grid.
Exactly. Texas experienced its second warmest first quarter since 1950.
Just totally mild.
Yeah. Heating degree days were only 73% of normal.
Let's pause and really explain the mechanics of a retail electricity drag here. Because to, an average person, a mild winter just means, hey, a lower power bill, great.
Right. It's good news for a homeowner.
Right. But to a vertically integrated power company like Vistra, a mild winter is an absolute logistical nightmare. How exactly does mild weather destroy their retail cash flow?
It comes down to forward hedging. Vistra has millions of retail customers in Texas. To guarantee power for those homes, Vistra's trading desk goes out and buys strips of electricity months in advance.
Okay.
For locking in a specific volume of megawatt hours at a set price, assuming a normal cold winter load.
Yeah.
They pre-purchase the power.
But then the winter is incredibly warm. Nobody turns on their electric heat.
Right. So now Vistra's retail arm is sitting on millions of megawatt hours of contracted power that its retail customers just don't need.
And you can't easily store electricity at that scale.
No, you definitely can't. So Vistra is mechanically forced to dump those excess pre-purchased electrons back into the ERCOT wholesale spot market.
I see.
But because the weather is mild across the whole state, overall grid demand is virtually non-existent. Spot prices just absolutely crater.
Wow. So Vistra has to sell off their excess inventory at a huge discount.
Exactly. They take a massive loss on those specific hedges. And that is why their retail segment cash flow heavily moderated down to just $68 million.
So the retail arm takes a total beating, dropping to $68 million, yet they still post a $1.5 billion quarter overall.
Yep.
So how does this all-terrain vehicle generation model step in to save the day here?
Because Vistra isn't just a retail provider. They're the largest competitive power generator in the country. So while the retail side bled, their flexible merchant fleet saved the balance sheet.
Which segment is this?
The wholesale generation segment. It delivered $1.426 billion in adjusted EBITDA alone.
Wow. How do they pull that off?
By exploiting the PJM grid, which operates very differently from Texas.
Okay, let's contrast them. PJM covers the Mid-Atlantic and the Midwest, What's the fundamental mechanical difference between PJM and ERCOT?
Well, ERCOT is an energy-only market. You literally only get paid for the electrons you actually produce and inject into the grid.
Okay.
But PJM operates a capacity market.
Yeah.
In PJM, power plants are paid a huge premium simply to exist.
Just to be on standby.
Exactly. They get paid to guarantee they will be available if the grid gets stressed, regardless of whether they actually turn on that day. And Vistra saw structurally higher cleared capacity prices across their PJM fleet.
Plus, they ran a really robust forward hedging program on the generation side, right?
They did. They locked in high power sales prices before the spot market crashed. And it was also the first full quarter of their 2,600 megawatt Lotus gas plants being online.
So they were fully insulated. And there's also a hidden gem in their 10Q regarding liquidity velocity, right?
Oh, definitely. Their net cash from operating activities surged to $1.199 billion.
That's a massive cash injection. Where did that come from?
It was heavily optimized by the structural return of $67 million in cash margin deposits.
Oh, because the forward power curves finally normalized?
Exactly. When markets are volatile, you have to post huge margin deposits. When things calm down, you get that cash handed right back to you. So they are operating with incredible liquidity right now.
Okay, so that establishes the baseline. Both companies are printing cash today, despite some weather anomalies and messy integrations.
Right.
But what we really care about, what everyone is watching, is how they are securing the future. Which brings us to the multi-decade power purchase agreements, or PPAs, with big tech. Because we aren't just talking about selling power to the public grid anymore. We're talking about essentially privatizing massive infrastructure assets to monetize the cloud.
It is the single largest shift in infrastructure capital allocation of our lifetime, hands down.
It's crazy. And Constellation really fired the shot heard around the world with their Microsoft anchor deal.
They really did. This is their crowning achievement.
Let's detail the mechanics of this because it's wild. Constellation secured a 20-year exclusive clean energy PPA with Microsoft. But they didn't just reallocate some existing power plant.
No, they didn't.
Microsoft is fully reviving the shuttered 835 megawatt 3 Mile Island Unit 1 reactor.
Yeah, they're rebranding it as the Crane Clean Energy Center.
Right. But Microsoft is buying 100% of the generating output to push its PJM data center networks toward a 247 carbon-free matched state.
Which is an incredibly important distinction. We really need to explain the mechanics of what 247 carbon-free matched actually means.
Go for it.
Historically, a tech company would claim to be 100% renewable using accounting tricks like renewable energy certificates or RECs.
Like they'd buy a solar farm somewhere else to offset their usage.
Exactly. They'd build a data center in Virginia that ran on coal power at night. To offset that, they'd fund a solar farm in Arizona. And on an annual spreadsheet, the solar megawatts in Arizona equaled the coal megawatts in Virginia, net zero.
But the actual electrons powering the servers in Virginia were still dirty.
Exactly. But AI data centers are pulling 500 megawatts to a gigawatt of power continuously.
It's just a different scale entirely.
Yeah, they cannot rely on intermittent accounting tricks anymore. Microsoft's mandate requires physical, time-stamped, clean electrons hitting the actual local grid every single hour of every single day.
Which solar and wind just physically cannot do.
Right, because the sun sets and the wind stops. Only baseload nuclear can do that.
Yeah.
So Microsoft needs this Crane Clean Energy Center to pump 835 megawatts of pure, uninterrupted baseload directly into PJM.
So Constellation gets this massive enterprise anchor. But Vistra, again, playing the agile role. They went out and executed a completely different strategy with Meta Platforms.
They did. Vistra locked down 3 separate 20-year nuclear PPAs with Meta.
And what's the scale of that?
It's 2,600 megawatts of capacity across Vistra's PJM nuclear assets.
Wait, 2,600 megawatts? That is the equivalent of what, like 2.5 modern nuclear reactors?
Basically, yeah. Locked up entirely by Meta. Because Meta needs that absolute baseload reliability to ensure continuous server computations for generative AI. They have to bypass weather-dependent constraints.
It sounds like these tech companies are essentially becoming shadow utilities.
It does, doesn't it?
Are they just panic buying capacity at this point?
This raises an important question, right? But it's not
Yeah.
panic. It is a structural necessity for survival in the AI arms race.
Okay, how so?
They are protecting themselves from volatile merchant spot market price shocks. If you need a gigawatt of power, you can't be subjected to the daily whims of the spot market. You have to lock it in.
And Vistra is also doing some really interesting financial engineering on the solar side with Meta, right? Leveraging their newly energized Newton solar infrastructure.
Yeah. Vistra secured transferable federal investment tax credits, or ITCs, from that Newton Solar project.
Explain how that works, because transferable is a key word there.
Normally, a tax credit is just something you use to lower your own tax bill, but Vistra already has a highly optimized tax structure. They don't need all those credits.
Right.
So because they are transferable, Vistra can literally sell those tax credits on the open market to a massive corporation like Meta that wants to lower its tax bill. Vistra gets immediate upfront cash flow, which essentially subsidizes the capital cost of their solar build-out.
That's brilliant. They're monetizing the tax code. But let's pivot away from big tech for a second, because if you look at the commercial use cases in our source material, this power grab isn't just an AI phenomenon.
Not at all. Traditional commerce is getting involved too.
Yeah, Walmart just made a massive play. They signed a 15-year nuclear PPA with Constellation for 176 megawatts out of the Dresden Clean Energy Center in Illinois.
Right.
And this includes 30 megawatts from planned nuclear uprates, which we'll get into. But first, why on earth does a grocery chain need a 15-year nuclear deal?
It's all about supply chain logistics. Walmart is transitioning its network to highly automated perishable distribution facilities.
Okay.
They're building this massive one in Belvidere, Illinois, starting around 2029 or 2030. This facility relies entirely on robotics, automated sorting, and deep freeze logistics.
No, they can't afford a brownout.
Exactly. If the grid stutters during a heat wave, they lose millions in perishable inventory, so they're locking in absolute price predictability. Nuclear fuel costs are stable compared to gas.
Right, it protects their operating margins from inflation.
Which is how they maintain their core promise of everyday low prices.
Now, let's talk about those uprates. The sources say 30 millidito of the steel comes from planned uprates at Dresden. What exactly is a nuclear uprate? They aren't building a new reactor, are they?
No. Building a new reactor takes over a decade. An uprate is basically an engineering workaround. You take an existing operating reactor and you completely overhaul the secondary, the non-nuclear systems.
Like the turbines and things like that.
Exactly, yeah. You swap out the high-pressure turbines for, more aerodynamically efficient models. You upgrade the heat exchangers.
So you're just increasing the thermal efficiency so the exact same nuclear core produces more electrical output.
Yep. It's pure operating leverage.
And it's not just Walmart. I found a critical detail in Vistra's 10Q regarding Amazon Web Services, AWS.
Oh, yes, the Comanche Peak deal.
Right. Vistra signed a 20-year PPA with AWS for 1,200 megawatts from the Comanche Peak nuclear power plant in ERCOT. And that starts in Q4 2027 and ramps up by 2032.
So everyone is locking down this long-term capacity.
But here's the massive structural bottleneck.
Yeah.
Signing a 20-year deal for power in 2027 or 2030 is great, but tech firms need power now, which brings us to the speed-to-power frontier and the colocation race.
This is the real battleground.
Right, because data centers can't wait years for grid access.
Explain the public utility interconnection queue problem to us.
It's a huge issue. You have these tech companies with practically unlimited capital, colliding headfirst into public grid bureaucracy.
Why can't they just plug their data center into the transmission lines?
Because if you drop a massive 500 megawatt load onto a random point in the grid, you can literally melt the transmission lines.
Oh, wow.
Yeah, it causes cascading blackouts. So grid operators have to perform these exhaustive interconnection studies, which takes years. The queue is incredibly slow.
So how is Vistra solving this? Because they're deploying some really tactical assets to bypass this queue entirely.
They're providing bridge power directly on site. They have these advanced Permian Basin peaking units expected online by the second quarter of 2028.
Peaking units being fast-responding natural gas turbines.
Right. And they're executing coal-to-gas conversions at legacy sites like Toledo Creek. They're taking old coal infrastructure, ripping out the boilers, and putting in state-of-the-art gas turbines, which lets them use the existing water rights and substation infrastructure.
Exactly. It vastly accelerates the timeline. Plus, Vistra's CEO emphasized that with the December 2025 FERC colocation order forcing PJM to support colocation, they can do these behind-the-meter deals with gas, not just nuclear.
Don't forget the Cogentrix acquisition.
Oh, right. The massive pending acquisition of the 5,500 megawatt Cogentrix natural gas portfolio, expected to close in the second half of 2026. They are scaling their gas bridge power heavily.
Okay, so Vistra uses gas to bridge the gap. What about Constellation? What is their colocation strategy?
They just secured a landmark powered land deal with Cyrusone at the Freestone Energy Center in Texas.
And the regulatory win there was huge, right?
It was. They secured formal Public Utility Commission of Texas, or PUCT, approval for a net metering agreement at Freestone.
Explain why net metering matters so much here.
It effectively lets Constellation run a private cable directly from their power plant to Cyrusone's adjacent data center. The power never touches the public transmission grid.
So they completely bypass the queue and the grid bottlenecks.
Exactly. And the economics are staggering. Achieving this net metering agreement translates to a 20 to 50 cent earnings per share impact per every 1,000 megawatts deployed.
Just massive EPS accretion. Now, mapping this out, we have to talk about the political realities shaping both of these footprints, because we're currently under the federal administration's all-of-the-above energy doctrine.
Right.
And to be clear to you, the listener, we aren't taking any political sides here. We're just impartially reporting on the structural tailwinds outlined in the source material.
Yeah, we're just looking at the regulatory mechanics.
Exactly. So detail this administration's aggressive push for behind-the-meter autonomy. How is this all-of-the-above doctrine changing the game?
Well, the sheer magnitude of this geopolitical AI arms race has forced a shift. The administration has essentially removed legacy EPA environmental restrictions on thermal assets.
Which provides a direct lifeline to Vistra's fossil units, right?
Absolutely. Suddenly, their coal-to-gas conversions and gas-peaking units are politically protected strategic assets, rather than regulatory liabilities.
And what about Constellation? How does the nuclear purist benefit?
Through an expedited 18-month Nuclear Regulatory Commission, or NRC, licensing mandate.
So they cut the red tape.
Exactly. Historically, the NRC was notorious for dragging out approvals for years. The new mandate speeds that up, which completely de-risks Constellation's timeline for things like the 3 Mile Island restart.
But there's a flip side to this political reality. The White House also issued the Ratepayer Protection Pledge because politicians are terrified of residential utility bills doubling while tech companies hoard all the power.
It's a huge friction point.
So how does the pledge work?
It mandates that the massive capital costs of upgrading the grid for data centers must be borne by the hyperscalers themselves. It insulates the residential ratepayer.
And we're seeing that play out mechanically in the PJM emergency capacity auctions, aren't we?
We are. Because PJM is facing a capacity shortfall, these emergency auctions cleared at record highs. Hyperscalers are essentially being forced to pre-fund $15 billion in regional plant construction just to guarantee systemic capacity.
Tech is literally bailing out the public grid.
You kind of have to.
Okay, so with all this cash gushing in from big tech and emergency auctions, what are these companies actually doing with the money? Let's dissect their capital allocation and equity retirement strategies.
This is where the two models really diverge again.
Yeah, let's start with Vistra. The sources refer to Vistra as a pure share cannibal.
It's an aggressive term, but it's totally accurate. Vistra is systematically retiring its own outstanding equity base.
Lay out the numbers for us.
Just between March 31st and May 1st of 2026, just 1 month, they deployed $144 million to repurchase about 913,000 shares.
Wow.
Yeah. And in the first 4 months of the year alone, they deployed $525 million into buybacks. Since 2021, Vistra has successfully retired 30% of its entire outstanding equity base.
Almost a third of the company deleted, so every remaining share claims a vastly larger percentage of earnings.
Exactly. And they have $1.5 billion remaining under existing authorizations through 2027. They're targeting at least $1 billion in buybacks and $300 million in dividends annually.
And their balance sheet totally supports this, especially with their recent investment-grade graduation.
Right, that was a massive milestone. It completely released all of their corporate asset liens. Their debt is now unsecured, freeing up billions in trapped liquidity.
Yeah, the sources say they expect to generate over $10 billion in cumulative cash to allocate across 2026 and 2027. So Vistra is a cash machine today.
Very much so.
Contrast that against Constellation's scaling cash explosion, because their model right now is highly capital intensive.
It is. They are carrying roughly $17.5 billion in total debt while they navigate the Calpine acquisition and fund these nuclear restarts.
But the forward view is where the payoff is, right?
Right. They are forecasting a 45% free cash flow acceleration. They're looking at $11.5 billion to $13 billion in free cash flow in the 2028 to 2029 window.
Over $11 billion in free cash flow. Not EBITDA, but unencumbered cash.
Exactly. So Constellation's capital return today is relatively muted, but it's a coiled spring waiting for 2028.
So what does this all mean? We need to synthesize the comparative investment case and deliver the final verdict on which firm is better positioned long term.
Well, here's the dichotomy. Vistra trades at a noticeably cheaper forward multiple around 14x. They are your highly agile, value-focused generalist.
Right.
They're a cash machine harvesting high-velocity load growth inside the deregulated Texas grid.
And Constellation.
Constellation trades at an elevated premium, a 22x forward PE, but they offer the highest quality, carbon-free, purest portfolio in the country, backed by decades-long contracts with the biggest tech companies in the world.
But we can't end there because there are core hidden risks facing both of these unregulated utilities that investors need to know about.
Definitely. The first is the upcoming January 2027 PJM capacity price cliffs.
Right. Because all that $15 billion in pre-funding from hyperscalers is going to trigger a wave of new supply gas plants, batteries hitting the market at the same time.
Exactly. And when you flood a capacity market with new supply, clearing prices collapse. It's a boom and bust cycle.
What about the nuclear side?
Well, there are persistent execution delays on nuclear upgrades. Even with the NRC expediting things, it's still complex engineering. And crucially, no earnings accretion from those upgrades hits until 2030 at the earliest.
So you're paying a premium today for execution that's years away.
Exactly.
And if we connect this to the bigger picture, there is one final provocative thought I want you, the listener, to mull over. It's the high equity volatility tied to technology capex.
Is the elephant in the room.
Yeah. If Microsoft, Meta, or AWS suddenly recalibrate their AI spending, or what if the physical chips become exponentially more energy efficient?
If algorithmic efficiency doubles, the baseline power required drops in half.
Right. So what happens to these massive multi-decade energy contracts if the artificial scarcity of electricity evaporates? It's a question of whether these energy titans are riding an endless structural wave or if they're just surfing a massive AI hardware bubble waiting to pop.
It's the ultimate derivative trade on tech capital expenditure.
It really is. Well, thank you for joining us on this deep dive. Keep looking beneath the surface of the markets, and we'll see you next time.